This is the Propcast, and I'm Louisa Dickins. Before we introduce our guest, here's a quick word from our sponsor.
Hi, I'm Leon Cantor from Future Place, organisers of the largest tech and innovation event for real estate in Australasia, the Real Estate Innovation Festival, taking place from 9th to 10th of November in Sydney. For more information, please visit realestateinnovationfestival.com.
Today on the Propcast, we are joined by two guests from McKinsey, which is the trusted advisor and counselor to many of the world's most influential businesses and institutions. I'm sure lots of you listening, you've definitely heard of McKinsey. And I would like to welcome Daniel Stevens, who's one of their senior partners, and Farzana Huysman, who's project manager, to the show. So welcome, Daniel and Farzana.
Hi. Thank you for having us.
Yeah, great to be on. Thanks.
Now, everyone listening in, Farzana kindly stepped in very last minute, but both our guests, they've obviously been working at McKinsey, we all know who McKinsey is, but they are not a PropTech specialist. They are going to be talking about strategy consulting around sustainability and ESG more sort of loosely. So hopefully we can get a few key takeaways when it comes down to decarbonisation strategies and all things sort of ESG. Obviously, we'll start off first hearing a little bit more about what their roles actually entail. And they're going to be talking about what risks and strategies and findings they're seeing and spending most of their consulting time on. We're going to hear what common themes and questions they get asked by clients. And this could be from finance. It obviously could be from real estate. It could be from insurance and so forth. Now, we're also going to learn a little bit more about other decarbonisation strategies which they've been focusing on and what other organisations are doing. But look, it's the first non-properly real estate focused podcast we're doing, but within ESG, we have a huge amount to learn from adjacent industries. So I thought it was kind of perfect timing to finish the podcast on this one. So look, Daniel, why don't you start us off with introducing the audience a bit more about you, what your role is, and also everyone listening in. Daniel is also the global co-leader of McKinsey's climate ESG finance practice. So he knows a fair bit about the ESG space. So Daniel, please go for it.
Yeah, sure. So, the thing, as you said, the thing I do is I run our climate sustainable finance practice. And obviously a huge piece of that is real estate finance, whether that's commercial real estate or multifamily or single family I think of agriculture as just another form of real estate finance in a lot of ways also. And so, we work with the big banks, the big investors, including the real estate investors, the insurance firms, the asset managers, all on some version of the question of how does sustainability going to impact my financing business and what do I do about it?
Now, Farzana, what about you? You're obviously on the project management side. You obviously came from sort of building engineering. I know you're fairly early on in your career, doing obviously extremely well, but what led you up to joining McKinsey and what are you sort of doing day to day?
Yeah, sure. So, my background, as you say, is in engineering. I did mechanical engineering. I also worked in the built engineering space, so both in kind of the structural engineering and then a bit in facade engineering, which we may touch on, a bit later, because I think that has quite strong links to sustainability. But within McKinsey, I am now working at the intersection, I call it, of financial institutions and sustainability. So essentially, working with banks and insurers and looking at how, the sector can help to unlock the net zero transition. So thinking about, how do they finance the decarbonization journeys of a whole host of companies and clients out there? How does this sector play a role in absorbing a lot of the risk that comes with the transition? And, things like what is going to be the impact of climate change on the investments that, the banks and so on have made? These are the types of questions that I help clients to address.
Amazing. Well, Farzana, you've teed us up very well for the first question, which I had, and everyone listening in, I very much said to Daniel, Farzana, I have plenty of unanswered questions and I'm not a specialist in space. So let's start off with the first question. Now, you both spend a lot of time in risk assessment. What sort of risk are you assessing? Like, how do you assess also on a risk when it comes down to climate when there are so many unknowns as well there? And then my next question will go on to, are risks always visible on the portfolio? And then, so Daniel, maybe you can kick us off with your answer for this first question.
I think if you just read kind of the popular press on climate risk and real estate, you'd come away thinking this is maybe mostly about physical damage, hurricanes and heat waves and flooding. And maybe it's mostly about long-term physical damage. How bad will this be in 2040 or 2050 or 2060? I actually like to think about it very differently. I like to think about what are the financial impacts in play today in properties I own today or properties I invest in or lend on today. And how might those risks manifest today? In my mind, that's you're basically asking a question about asset productivity. You're saying, is there some reason this asset is going to be less productive than I thought it was? And it could be less productive for a variety of reasons. One might be that it is damaged by some physical event. But actually, that's not the primary thing we worry about in real estate risks with respect to climate, because oftentimes that damage is insured. For example, oftentimes it doesn't permanently handicap the property value. We're actually much more interested in things like, will the expectation of future physical risk cause potential buyers to devalue this property now? So think about agriculture is a great example of this. If I knew a plot of land were in a place that over 30 years, heat stress would make it less productive, I should be willing to pay less for it now, even though heat stress or drought hasn't yet impacted it. My expectation that it will should make it less valuable now. So that's when we think about the risks. That's what we're really most interested in is what would cause a property to be less valuable now than I've assumed it would have been. And that's very often about anticipating future impacts and how they're capitalized, they're pulled forward into a market price.
So it's very much looking at sort of the mid to long term, not the short term where, like, I don't know when this is coming out, but obviously Florida's in the midst of Hurricane Ian, and obviously there's a huge amount of damage to sort of real estate, but I guess that can be fixed, that can be insured. But looking at sort of major portfolios, it's working out the issues aren't visible now, but there's 30 years time there will be a huge impact.
Yeah, and the question is, like, does that impact the price today? Right? That's what should get you worried. Is there a reason to think that changes the value of the property today, even though the impacts may not happen for many years?
Yeah. Farzana, what about you? What do you spend most of your sort of time on? You mentioned about some common questions you keep sort of getting asked. Is it, around risk? Yeah. Is there anything you want to elaborate on there?
Yeah, sure. So essentially, the bulk of the work that I'm doing at the moment is working with, for example, banks that have set net zero commitments. And specifically, what they've set out to do is to reduce their financed emissions. And that means, for every dollar that they lend, what are their emissions associated with, kind of their lending and their earnings? And they've all set out commitments to reduce that to 2030 and to 2050, which is great. But if you think of what a bank actually has to do to achieve this, they essentially have two options. So option number one is you divest any high emitting assets or lending that you're doing. But of course, that is not great business because, you then lose kind of the income associated with that. And so the second option then is you support your clients in becoming greener. So in, either investing in technologies or that help to reduce emissions of existing assets, or you help them invest in new green businesses. To simplify it, this is really what I look at. And there are then a number of risks associated with that, and particularly with the shifts to new green technology. So in a number of cases, the banks are helping their clients invest in technologies that are, they have been demonstrated, but in some cases not yet proven at scale. Or, they're entering new markets and there's risks associated with that.
Yeah.
Or sometimes, getting the economics right is dependent on carbon prices being at a certain level or receiving a certain level of, subsidies or grants from governments. And so there's quite a lot of risks in that, in the sense of getting some of these new green kind of technologies and businesses up and off the ground, be it kind of renewables or hydrogen or, electric vehicles. These are the types of kind of risks I think about.
Okay. And what about, so you mentioned about them moving to sort of green, I guess becoming sort of green banks. I read like a green bank is a happy bank. And has this been, when they transition into this, Daniel, when we were last on, you spoke about transition risk. What are the questions and themes that sort of come from that as well when banks say, right, okay, we're going to do something about this? Or say real estate, right? We're going to transition, we're going to get to net zero. How do you incorporate that into a strategy? You might have to break this down to layman's terms to me in the audience.
Well, let's start with what a transition risk is, because I think the physical risks are very intuitive to people. The transition risks, I think a good way to think about them is, are there things about the way the economy works that are going to change and disadvantage me somehow? And policy is the easiest version of that, right? Is one transition risk would be if the government puts in place a carbon tax that changes the price of goods and services, and that's a transition risk because it raises prices on certain goods and services and causes them to be more expensive and therefore probably consumed less. The transition risks are interesting because they are potentially much lumpier in the way they would show up. Meaning you could go overnight from no risk to a lot of risk just because of a change in public policy, for example. And they aren't necessarily foreseeable. The way the physical risks work, we have a very good understanding of how they will manifest on average over time. And there's variability around that average, but we know the average. For transition risks, you can't plot a trend line, right? Because they can come suddenly or not, because you're relying on political processes, for example. So they're in some ways more volatile. Now, that said, most businesses already deal with something that looks like that. They deal with price volatility, for example. So they don't necessarily show up in a way that businesses don't know how to handle. I think the question in climate transition is, do they show up at a magnitude that's different than they have in the past? So a simple thing is to think about oil prices. Oil price volatility is something everyone, not just oil firms, we all live with oil price volatility and the cost of fuel. A transition risk is there a permanent step change in oil prices that isn't just the result of volatility, it's a permanent shift in the economic structure that you then have to deal with.
Farzana, is there anything you want to add on to that?
Yeah, I think that sort of covers it. I think maybe to go back to one of the previous things you asked is, what else are clients asking about ESG and the transition, right? And I think, one of the big things to highlight there is data, which, you may have faced similar things in the kind of real estate world, right? But if I go back to the original question that I set out, how does a bank reduce its financed emissions? In order for them to work out what their financed emissions are, and ideally work this out, year on year, they need to have a view of what the emissions linked to every single asset that they, finance are. And that's a huge data collection tracking exercise, particularly with most banks, they have a pretty broad geographical portfolio. And, different countries are at different levels in terms of, how much ESG data is reported and so on. And so I guess the data question is really, really relevant and top of mind. And the second question is, something around what should they invest in now, right? Like if you think about all the technologies that are emerging and you see a lot of them in the news, right? What should they think about going after now versus in 2030 versus, slightly later? And how does this vary by country? Because certain technologies are more advanced in certain markets.
Yeah.
These are a couple of the things that I think keep coming up repeatedly. And this is specifically, looking towards how do I kind of shift my portfolio to a much greener portfolio over time.
Yeah, I think Daniel would agree with me here. Yeah, data is definitely an issue within sort of real estate. There's some technologies which stand out specifically within sort of real estate when it comes down to sort of data management. I think there's Matt Ellis's Measurabl, which Daniel, I don't know if you've heard of, but that's pretty widely adopted across the US and Europe. But yet still sort of early days, but it's a problem which I think lots of people sort of trying to solve at the moment.
I think this is one of these big inflection points we're at right now, that the data environment required, we've been in this sort of voluntary regime where sustainability topics were a little bit of a luxury good. And that the bar on data wasn't particularly high because it was sort of all voluntary and nice to have in the first place. We're shifting to a regime where the insights into sustainability topics, whether that's risks or emissions disclosures, whatever they are shifting from voluntary to required or mandated. And therefore, the criticism and accountability around a lot of this data actually, I think, goes way up. the machine around this data isn't built for that yet. So there's a huge shift, I think, from this sort of voluntary, nice to have data to required and auditable and reliable data, which creates a bunch of opportunities for data providers, I think, in the space, and creates a bunch of risks for data users.
Yeah, completely. But then what about the next question that clients must be asking? So obviously you're saying more, obviously everyone's going to have to start saying, where they are at in terms of emissions and when they're trying to get sort of net zero, whether it's 2030, 2050. But we mentioned about other geopolitical issues and like the energy crisis, oil prices sort of going up. When people are trying to sort of balance out, I guess, energy prices, maintaining profit on their company to obviously, I know they're soon going to have to release the data of what their business is emitting, but there's still not sanctions everywhere. As a client, I would say as a business owner, if I was running a huge business, I would probably be asking, right, what strategy do I need to go for? Because obviously you can look at the short-term strategy, the mid-term, the long-term. But until there's proper fines or sanctions in place, I probably wouldn't be making too many decisions. Is this happening? What are you seeing in the market or some of your clients? I'm sure there's a lot of people just sort of saying, yeah, I'm going to do this, but they're not actually pushing forward with it.
Well, certainly there's, I think, a set of firms across industries who are maybe haven't made commitments yet with regards to sustainability, who are waiting to do so, maybe ready to, but are waiting to do so until the regulatory landscape's a little bit more clear.
Yeah.
And that's true about, for example, the SEC public reporting rules in the US, which aren't finalized yet. I think there are firms waiting to say, let me make sure I understand the landscape before I go out and make new commitments. I think many firms, and I think this is the right idea, are behind the scenes, are kind of preparing the engine room, even though they aren't maybe saying much more publicly. Behind the scenes, they're getting the data and the analytics in place to identify opportunities to measure the emissions or risks they want to measure. And actually behind the scenes, they're getting much smarter, even though on the surface, they may not be saying much more.
I guess my next question as well, this is, Dana, you've been in this space for a significant amount of time. You mentioned about obviously people waiting to put something in place. What are the major trends and changes you've seen when it comes down to, within real estate, since working at McKinsey? It's a fairly, I guess, a large question to answer, but then this will sort of tie quite nicely into my next question for Farzana and what she's seen in, I guess, finance and insurance space since being in it, and decarbonisation strategies increasing.
Yeah. Well, let me start with real estate, and Farzana, you should talk about the finance world more broadly. I mean, we hit on some of them, right? We talked about this shift in the quality of data and the criticality of data. I think there's another inflection point, which is what I think of as disaggregation. What I mean is 2-3 years ago, you could effectively talk to investors if you're talking to the pension funds or the big asset managers, to private equity investors. You could effectively talk about ESG sort of as one thing. But I think increasingly, investors in particular are looking to understand it more granularly. So they're trying to understand, well, ESG includes a huge breadth of topics. Which one exactly, one or ones, has financial impact on this business, and which ones are we trying to lead on versus which ones are we trying to be a follower on? That it's a much more granular conversation than it was a couple of years ago. And then I think there's a shift towards the transition. And what I mean is, we've been in kind of an era of sustainability build out, which has been mostly about, phase one has been mostly about building new green stuff. And that's been true since right after the financial crisis, so 2010 or 11. Most of the capital at work, most of the real estate at work has been about building utility scale solar and wind power. And we're shifting to a second phase where that's still true. We still have to build a bunch more renewable power, but we're now shifting to a phase where we're dealing with much harder topics, like how do I handle hard to abate sectors like aviation, where there's not a good replacement for a fossil fuel intensive process? Or how do I create energy storage solutions that enable renewables to take up more share of the grid? So that's long duration storage or hydrogen. How do I do energy efficiency at scale? That's the one that hits real estate the most. How do I transform my stock of real estate to make it more efficient? That's a much, much, much harder problem than it was to just build more solar or to build more wind. And I think we're just now entering that phase.
And now, Farzana, what about you? So obviously not specific to sort of real estate, you've obviously worked on decarbonisation strategies in the finance and insurance sectors. You've worked with some pretty large companies as well globally. Can you share with us a little bit more what you've seen in those areas? And if you want to elaborate on any sort of strategies you've been looking at in terms of new green businesses, adapting to sort of new physical climate risks, I would love to hear a bit more from you.
Yeah, and I think this actually flows on really well from where Daniel left off on the next phase of these technologies. And so the specific example that comes to mind of real leaders in making the big bets in some of these slightly newer technologies, so think green hydrogen, sustainable aviation fuel, and so on. I see the leaders as those who can convene partnerships across the entire value chain of these technologies. And so at its simplest, some of these value chains are literally, you have some inputs, you have a process or a production, step, and then you have your outputs, or, the people who want your product. And what you see is that some of these companies that are, really making the big bets are able to get a set of players across this entire value chain to come together to launch something probably in a bigger scale than anyone could do individually. And if I give a couple of examples of where you see this playing out. So green hydrogen is an example.
Mm-hmm.
So for that, you often find that you have these large projects set up in which you have a renewable energy supplier, hydrogen producer, you probably have an electrolyzer manufacturer, and an end user, be it in steel or in fertilizer, all come together and say, we are willing to put up this partnership in which we guarantee supply of the inputs is obviously the production phase, and we guarantee demand. The end user has guaranteed to take up a certain amount of the, hydrogen production. And going back then to, the work that you do in the financial institutions, this is then seen as a much safer and more investable project because you have guaranteed inputs, you have guaranteed off-takers. It lowers a lot of the risks of, am I going to put up a hydrogen production facility and I don't secure enough outputs? Or am I going to put up, this facility, but I'm not able to get the renewable energy I need to make it green? And so you see a number of these partnerships emerging, and they really are leaders and probably able to get to scale much faster. And so, this is one of the really exciting things I think I see kind of happening, where you see really large players actually coming together, in hydrogen, in sustainable aviation fuels, in green steel. There's quite a number of examples across different decarbonisation technologies.
Yeah, I think also there's some VCs, like, was it Fifth, I can't remember, it was like a few months back, raised $500 million, which I know for other industries, it might not seem that big. That's massive to invest in, I guess, more sort of climate tech, and they're doing a lot more sort of around green tech, and then other businesses, whether it's sort of British Land and other developers sort of just dipping their toe and raising some money to help, I just decarbonize the industry, but without them sort of fully committing to it. But everyone always talks about the 39% of total global emissions coming from sort of real estate. They don't like sort of, I don't think people talk about like the other industries like transportation, which is, I think, responsible for around 27%. You've got to ask, what are the other industries contributing to it? I always think it's good to see comparisons, see what key takeaways or learnings you can from other industries.
Here's a word from our sponsor.
With inflation at its highest since 1982, we want to make sure that both our clients and candidates are prepared for a shift in the PropTech market. A huge advantage of our consultants being 360-degree PropTech recruiters means that we can communicate regularly on both sides of the business. Our job is to make both the hiring process easier for clients and the job searching process easier for candidates. In short, a recession can be intimidating, unpredictable, and tumultuous. But it doesn't need to be. We at LMRE are here to help. Head to our website, lmre.tech, and we can find the right talent for your company's needs.
Daniel, you obviously have more experience in real estate, and Farzana, you can maybe just, say like 2 questions you have your clients like asking, which our audience listening in, who lots of them are from the built environment world, should be asking. Daniel, do you want to go first?
Yeah, sure. I mean, first, I think it's worth saying it's very early days. It's not like this is a solved, the it's not like this is a solved issue. I think there are certainly real estate players, and I think this is true of the owners and investors, but also the ecosystem of providers. There's certainly a theme around energy efficiency. And in some markets, that's going to be about regulatory mandate for efficiency. In others, it's going to be purely because it improves the value of a property. But there's a huge opportunity to increase energy efficiency in real estate. And in many cases, that is a bankable or monetizable opportunity. I think there's a theme about premium pricing, basically, which we've had for a while, right? We've had premium pricing for LEED certified buildings, but is the willingness to pay going to continue to sort of allow premium pricing for more sustainable product? I think so. And that's very market specific, but I think so. But, in my mind, the most interesting thing happening is actually the sort of blocking and tackling in the engine room. That is, how do I understand these parcels and properties in more depth? And a lot of firms actually don't from the starting point even have the data to understand their portfolio in detail. So actually a lot of this relies on, how do I get insight into properties in terms of their opportunity for energy usage improvement, in terms of their risks from physical events, their how subjected they are to transition factors. And it's such a property specific question, because two properties in the same city might behave very differently. I think that's actually the most interesting thing happening, is people building that kind of dry powder to understand a portfolio in detail, so they're ready to act on it as the economic incentives come into place.
Is that also down to the real, and I'm also seeing this from LMRE perspective, where our ESG team, which basically is hiring more consultancy folk to get into the real estate world to consult on what they can do in terms of strategy and decarbonisation and all things ESG into the businesses, which loads of these hires haven't been made for, but there's like a skill, there's a education gap within the business of what to do with their portfolio. Because if you're from the capital market team, valuation team, whatever it could be, or gone through, everyone's come through, the same real estate course, you're not going to really understand what to do with the portfolio. Do you think there's also like a skill gap at the moment that needs to sort of change or evolve slightly, or build upon it?
Yeah, I think so. And I think if there's a few flavors of that. One flavor is just the landscape is moving so fast. The set of regulatory policies in place, the tax situation, things are changing so fast by market. And that's not, the velocity of change isn't something we're used to in the real estate industry, I think. And then the second is, a lot of the opportunities I think of is they're an inch below the surface of the water. They're not, a lot of them maybe from a pure cash flow basis, would you do this tomorrow? Well, maybe you would, maybe you wouldn't. From a valuation standpoint, maybe you would. That analysis requires a different skill set, a different assessment of the value, but it also requires a lot of understanding of the technical solutions. Exactly how the technical solutions work, exactly how they monetize, which is, I think you're spot on. There's a skill gap on that in the real estate industry. There's a skill gap on that in all industries, because the speed and trajectory of the transition of the economy is just different from what we've dealt with in the past.
We released a Fifth Wall survey with Fifth Wall. We did the salary survey, and we had a bit about new sort of skills needed for, I keep saying real estate, but like generally the built environment, whether it's a developer, an investment manager, a big software business, and they're all looking for these new skills to help sort of work out what they're going to do with their portfolio, what tech they're going to use, how they can extract the right sort of data to make, I guess, better decisions for the future. But that's a podcast for another day, guys. Farzana, what are the sort of two questions, just which you mentioned questions you get asked the whole time. What do you think are the two of the most important questions as a business owner you can ask when trying to make your portfolio or business more sustainable?
Yeah, I think I have to draw on the ends of the conversation you just had with Dan. So I really think it's about, there's two things. Number one is, what do I focus on? And number two is, how do I get the skills in? And I know we just touched on it, but I'll elaborate in a bit of detail. So I think with a focus question, there is so much out there in terms of climate solutions that you could tackle. And I do think businesses have to make an active decision on the breadth and the depth that they want, which then informs the capabilities and the resources that they have to build up, right? So are you going to focus on a couple of technologies and do them really, really well? And therefore the skills and expertise you build in your business is a couple of teams maybe aligned to each technology? Or do you want to say, actually, we'll cover a pretty broad range, but we won't go as deep in it. And if we need, extra knowledge in a certain topic, we'll reach out to the relevant experts, probably from outside our organization, to get that in. So I think that's the first fairly strategic decision, actually. Then the second one is, how do you get the skills in? And I think you've just spoken about hiring in new talent, which is, of course, extremely important. But I think there's a second bit to it, which is in a couple of years' time, I believe that everyone is going to need some level of proficiency on climate. And so the question is, you have a lot of people in your organization who already have, a lot of strength. For example, they hold relationships with clients, they know the fundamentals of the industry and so on. How do you upskill them to the right level for them to be able to have the climate conversations they are likely going to need to be able to have? And I had this question from all sorts of organizations, thinking about, is it learning programs I bring in? Is it kind of, you get an influencer within your company to sort of teach and disperse the message across others? But this is, I think, a very important one to cover.
Absolutely. I know there's some courses which, like, I think it's called Hillbreak, shout out to John who actually started up, which are basically providing this upskilling for the likes of, say, Savills and other businesses where the real estate folk are trying to upskill and have a better understanding for how they can make investment decisions for their portfolios and valuations, everything like that. But yeah, I think upskilling internally, everyone will need to. My brother's an asset manager, but he's taken his own time to make sure he knows what he's looking at and looking at sort of risk for the future when he's making investment decision. But 100%, there's plenty of things which people can do internally for their business without, I guess, hiring brand new talent. But I do think we need that. And, LMRE are here to help when you do need to. But look, I wanted to say a big thank you to Daniel and Farzana for joining this podcast, talking about, obviously, Daniel, you spoke more about it from a real estate point of view. And thank you for that, because you have so many insights and knowledge about this industry when it comes down to strategy around sustainability. Farzana, thank you for stepping into the last minute and talking more loosely about sort of from the finance insurance side too. And hopefully I'll catch up with you guys after the show. But thank you for joining.
Thanks so much for having us.
Thank you.
Making a high-quality podcast like this one takes a lot of work. That's a fact. But not when you hire a podcast company. With our white glove experience, we handle everything for you. From guest outreach all the way through to publishing and promotion, we handle it all. You show up to hold great interviews and build relationships with your guests, and we take care of everything else. Podcasting is not just about the audience. Every podcast interview is the start of a new relationship. With a weekly podcast, you'd build relationships with 52 ideal partners or prospects through your podcast interviews over the next 12 months. Do you believe that 52 new relationships would help grow your business? We do. Contact Jason at apodcastcompany.com and let's talk.